allow me to introduce myself. My name is Brendan Mills and I'm from CFO Dynamics. And what we do is we provide an outsourced CFO solution for our clients. And one of the niches that we've built is with the EXO product. So we've done a lot of work with Horizon clients and helping them from an accounting perspective get the most out of the system. So, we work in consultation with Mike and the team with our clients from Horizon. So my background, as you can imagine, is in accounting, but also a number of years ago, I also worked in tax practice. So what I want to provide to you today is an overview of what your accountant is going to look for at the end of the financial year. So we've invested in our EXO system, and we use that on a day-to-day basis, from a bookkeeping transactional type level and also at an operations level, so that we can get understanding about how our business is performing, whether it's through stock management, job costing, et cetera, but to give us an understanding of that. Now, coming towards the end of the financial year, what we're doing here is we're actually coming together and going, okay, I need to present this information to my accountant in a way that he or she understands and answers the questions that they want answered, so that they can prepare our tax return and financials in the most efficient form possible, which should reduce our costs if we do that, because they don't need to spend as much time doing our work. So what we're going to go through today is we're going to go through a step-by-step approach of what you need to provide your accountant, which I imagine most accountants these days provide their clients with a list of, provide bank reconciliation, provide bank statements, provide debtors reconciliations, et cetera. We're going to go one step further though. We're going to provide you with specifically what does the accountant look for when they're provided with this information, so that we can mitigate the back and forth with questions by actually knowing what they're looking for and presenting that to them in such a way so that, again, it reduces our time involvement and makes their process quicker and more efficient. So first of all, where does your accountant start? Well, from an operations perspective, the most important thing for us is we look at our profit and loss. We look at how profitable our business is. Now, one thing I should say before we get into the detail is that I imagine, if not all of you, the vast majority of you will have a strong understanding of how to use the basics within EXO. So today's not about how to do a bank reconciliation and things like that. It's actually looking at the specifics of what they're going to look for in terms of your accountant. The reason I mention this is because as we go through this in the test system, there's going to be some nonsense data within there. Again, the point of the data is to illustrate the point. Don't get too hung up in terms of the actual numbers themselves, because we know that they're, again, it's the old motor parts that we all would have been familiar with when we first started using EXO, but just bear that in mind. It's not so much about the numbers you see on the screen, it's the principles we're going to apply. So, I was talking about how from an operations perspective, the first thing we tend to look at is the P&L. Well, your accountant actually, when they're preparing your financials and tax returns, the first place they start is your balance sheet. Because the theory is, and it's not just a theory, it's actually a truism, for want of a better phrase, is that if your balance sheet reconciles, then your profit and loss naturally will have to be what it is. So they work on the theory, if we can reconcile your balance sheet, then the P&L will naturally fall out to be what it should be. So what we're going to do is we're going to do a screen version of the balance sheet, and we're going to keep coming back to this as we go through this process. So we've got our balance sheet. As I said, don't worry too much about the numbers, but we've got our bank account, debtors, stock on hand, work in progress, GST, our current liabilities, going down to our fixed assets, term liabilities, and our shareholder funds. And again, those shareholder funds will vary depending on whether you operate as a trust, partnership, or company. So the first thing your accountant will do is they'll get a copy of your balance sheet, and we'll need to provide that. And it's always a good idea when you actually give them the final copy, because more often than not, they won't have access to your EXO, is to actually reference the proof or the source data that you're going to provide to them back to the balance sheet. So for example, for the current bank account 4,000, you would put a worksheet behind it with the bank reconciliation and the bank statement for number 4,000. So let's start with the balance sheet. Now, just to be more efficient, I didn't do this morning, but it'll save time for us now. I'm actually going to print the balance sheet to PDF, because what I found was as override. That's fine. So I was just putting together the balance sheet I'm actually overriding is the test data that I did yesterday in preparation for today. So the reason I thought I would do that quickly was just because with TeamViewer, there's a bit of a habit of screens disappearing on you. So let's have a look. So we've got our balance sheet, and the first thing we're going to look at is our bank account. Now, we should all be in the habit, and I sincerely hope that we all are, and if we're not, well, you need to contact the Horizon team or myself as soon as possible. We need to be in the habit of reconciling our bank, worst case, monthly, ideally on a weekly basis because of the volume of transactions which we deal with on a day-to-day basis. So if I go into our utilities, look at our bank reconciliation. So the first thing as that's loading up that your accountant is going to look for, as it's taking its time. So I'll just pick the top of the list, the 21st of and if I go into here into our reports and go bank reconciliation details. So here I'm making the assumption that we've already reconciled the bank statement as at 30th of June. And with the way that the end of financial year falls, being on a Monday this year, we'll be able to reconcile the bank right up to the 30th of June. So if I go to the end of the bank reconciliation, the first thing, and don't need to, this won't be news to any of you, we need to make sure that what the closing balance per the bank statement is matches back between the general ledger, what they believe the bank statement should be. So after we've factored in undeposited receipts and checks compared to unpresented checks and payments, we need to make sure that discrepancy is exact. So as you can see here, don't worry about the numbers at all, but we've got a large variance here. We need to make sure that that difference is zero and that the bank statement matches in the reconciliation what the actual bank statement says. And then what is on the general ledger matches back to the reconciliation as well. So that's all well and good. That's the first thing. The second thing that your accountant will look for, now just one thing to bear in mind is that if your bank does not reconcile, your accountant will not go any further because they go, well, your bank doesn't reconcile. How on earth can I trust anything else within the financials? So that's the first thing. Make sure your bank reconciles, and if you've got multiple bank accounts, then making sure they reconcile before you send them through to your accountant, because that's going to save a lot of time. The next thing your accountant is going to look at is they're going to look for what we call old or stale transactions. So as you can see here, if I highlight just with my cursor these transactions going back to the 25th of April 2013, that's going back almost 15 months. So what the accountant is going to say is they're going to go, well, why haven't these transactions been reconciled? They should be reconciled by now. It's more than reasonable to assume that payments that have been made have been deposited and by the supplier, and also payments we've received has been deposited for us, received from our clients. So they're going to go, well, why haven't we received those payments or made those payments as per the bank reconciliation? So what we need to do is we need to look back, and this isn't just important from an accounts perspective at the end of the financial year, it's something we should do on an ongoing basis, is make sure that we don't have any stale or any old transactions in there. And if we do, we need to identify what has happened and why it's happened. So again, like I said, today is not so much about looking into the why and the how, but it's identifying that and going, look, that's something your accountant's going to look at and go, we need to rectify that, or at least acknowledge it. So one thing I mentioned this morning, and I say this slightly tongue-in-cheek, but also with the best of intentions, is that you need to treat your accountant, if you have any, like a teenage child. That's what I meant by if you have any. Treat them like a teenage child in that they want everything done for you, or for them, more importantly. So if you provide your accountant absolute detail in terms of what's happened, and also clarifications on things that on first appearance don't make sense or might need a clearer description, you have done that for them, because then they'll get confidence from you in terms of what you've completed and what you've done. So that's an important thing with the bank reconciliation. Another thing is if you do work with, or if you've got credit cards on your balance sheet. Now with the bank statement, it's easy to reconcile to the 30th of June or to the end of the month. However, with credit card statements, it's not necessarily always that easy. So there's two methods here. First of all, you might be dealing with your credit card via the statement. And the statements for credit cards generally come out mid-month. So again, it's impossible to reconcile to the 30th of June. My recommendation is to reconcile to the closest date or the first statement date after the 30th of June. So for example, if you receive a bank credit card statement on the 23rd of June, reconcile to that date. And also if you receive a statement to the 23rd of July, reconcile to that date. And then, pardon me, then provide that information to your accountant, because they will understand that, hey, look, if your credit card reconciles in this example on the 23rd of June and the 23rd of July, it's pretty fair to say that what has happened in between up until the 30th of June will be an accurate reflection of the accounts of the business. So that's important. And also I do know several clients who have access with their online banking where you can actually get a statement balance as at a point in time, so at the 30th of June. So if you're in that case, it's exactly like reconciling another bank account. So as we move forward, that's the first thing. So looking at your bank reconciliation and making sure that that is all fully reconciled to the 30th of June, and also for credit cards to either the 30th of June or to their statement date. If you've done that, then your accountant's on their way. So that's a really significant and important part of the end of financial year process. The next stage, let's look at our debtors. So if I go into end of month, now what they will want to see, your accountant, is they'll want to see that your aged debtors report at the final balance at the bottom matches exactly, so this balance here matches exactly to what is on the balance sheet. And as we know, in EXO, we've got this report which tells us any discrepancies. So if I go into this report here, you'll see that there's a discrepancy of $165. So it's saying that our receivables value is greater than what our account balance is. So what do we do in this circumstance? Well, I'm just going to go on to a couple of different examples here that we need to identify. First of all, this out of balance amount is really important. Basis. Now, obviously in an ideal world, we want the out of balance to be zero, and every single month we want it to be zero. But as we know, we don't live in a perfect world. So the first thing that you need to do, and I always recommend to people, especially the first time that I go and look at their EXO, is to go to their receivables, and it's the same with creditors, but we'll touch on that in a moment. With the receivables, look at the out of balance amount over a period of time. So for example, if I close out of June, it's $165. What happened in May? So if I look at May, and if there's a discrepancy here, as you can see, it's $124,000. So it's saying our account balance is in minus 94,000 and the receivables are $30,000. So obviously something quite significant has occurred in here to cause this error. So straight away, if you notice that your receivables reconciliation, and it's the same with the creditors, the out of balance amount is fluctuating each month. That is not a good sign, because it means fundamentally within the operations of how we process things within EXO is not being done correctly. So that's the first thing. If that occurs, you definitely need to identify the reasons why, first of all, and take corrective action. And then second of all, actually fix the error that has occurred, and I'll explain a little bit more about that in a moment. So we can see here $124,000 out of balance in May, down to $165 in June. So that's the first thing. We've noticed that there's a significant variance across month to month. What we need to do, if I go back to June, like I said, so let's say we assume we've taken those steps, we've identified the reasons why there's a discrepancy. Now, another thing about the discrepancy is you can have a variance and it be consistent over a period of time. This is not unusual, especially early on in using EXO, or maybe just one error which has potentially occurred. So for example, I've done some work with a client recently where they had a variance, they had a debtor's balance of approximately $600,000, and they had a variance of around $11,000. And that variance has not, or hadn't moved between July and February this financial year. So we made the decision to clear that balance. And also on the flip side, the receivables value was greater than the account balance. So what it's saying is that we're not foregoing money. We actually probably haven't processed all the transactions perfectly. There's probably some people that have paid us, and for whatever reason, that payment didn't get allocated correctly to their account. So that's the next best thing, is if there's a variance, and making sure that that variance is consistent. And the next stage after that is to make a judgment call. So like what we saw in May, there was a variance of about $124,000. In relation to the size of their business, that's a massive difference. However, $165 difference relative to the size of their business is an immaterial amount. So we need to make a judgment call on whether the out of balance amount is something that we can adjust. And that's something that at an accounts level, you need to consult management and, most importantly, the owners of the business regarding this and explaining why you're doing it. And also, if needs be, getting outside advice, whether it's from someone like myself or an accountant, or your external accountant, getting their advice as to whether it's a fair thing to do. Because using that $124,000 example, you don't want to be doing adjustments of that size. But at the same level, if it's an adjustment which isn't going to have a material impact on your business, then we can go ahead, and it's recommended that you go ahead and do it. The question was asked before, what is the other side of the entry? So as you can imagine, whether you need it to go up or down, one side of the entry will be debtors or your receivables account, and the other side of the entry will be to your sales account, so impacting your P&L. So that's the first thing. So in summation there with the receivables, identify whether there's an out of balance. Is that out of balance a consistent out of balance? If it's not a consistent out of balance, identify the reasons why that's the case. And also, as you can see with EXO, it provides a little report as to potential reasons as to why it's out. And then as a result of that, take corrective action. So the most important thing is to identify it. One thing that I talk about with clients is that I believe as at 30th of June, the end of month for June should be no different to every other end of month of the year. Because what we're doing here is, let's say, for example, let's say Motor Parts, the business we're looking at here, has had some issues during the course of the year, and we decide to draw the proverbial line in the sand and go, look, this is the adjustment we're going to make, and we're going to move on from here. What that does is that all of a sudden moves your time frame to identify areas into a very manageable period of time. So at the moment, Windows 8 tricking up on me. As we move through this, let's say with Motor Parts, I think the transactions go back 2 or 3 years. This error could be going back 2 or 3 years. It's not commercial to go back and look in that level of detail for that period of time. So what we're doing, though, is if there is an out of balance thing that occurs, let's say in July, we've isolated that to 1 month. It's going to be far easier to identify those variances just because we're focusing on 1 month as opposed to an infinite period of time potentially. So there are your debtors. As we move forward, we're just going to look at, so I turn my notes over. What we'll do is we'll look at your stock. So a couple of things just to bear in mind here. We've got the stock valuation report. So as we can see, if I go back to the balance sheet, so we've done our bank account, we've done our debtors account. The next thing down is our stock on hand. So we've gone in here, and let's say we just do it for Sydney. So as you can see, for this business, there's multiple locations. So if this was our business, we would need to make sure we print off the stock reports or stock valuation reports for all these locations as at 30th of June. Now, one thing I became aware of today, which is really good, I'll mention that in a moment actually. I'll start by the stock valuation report first of all. So a couple of key things. The accountant is going to want to make sure, so if I go to the conclusion of the report, that the stock valuation summary matches back to what is on the balance sheet as at 30th of June. And as we mentioned before, the balance on the balance sheet is also a combination of different locations, and we're just looking at one location here. So that's the first thing. Now I want to make sure that that reconciles back to the stock balance. The second point to note is stock take. Nobody enjoys stock take. And just as a quick anecdote, I was in my local Coles store on Monday night at about 8 o'clock, and the place was absolutely chockers, but it was full of employees doing stock take. So that's that was the 23rd of June. So they're a week out from the end of the year. They know that if they can do a stock take across all the stores during that period of time, that it gives them sufficient time that at 30th of June, they're going to have a very precise figure as to what their stock holding is as at the end of the year. So that's one point that's really important. As I mentioned, nobody enjoys doing it. It's not particularly fun, but it is an essential part of your business. So looking at your quantities, and also your unit valuation. So making sure that the value you put on the products is a fair valuation for them. So they're the other two areas to focus on. Now, the point I was going to make before, and the thing that I learned today, is my understanding with the EXO out of the box, so to speak, is that the stock valuation report is a snapshot in time. So this report is accurate as at 5 p.m. on the 25th of June 2014. The Horizon team told me that they actually can provide reports which will allow stock valuations in a historical perspective. So let's say we were running this report on the 7th of July, we could go back to the 30th of June and we'll be able to get a stock valuation report. So if that's something that is relevant and that you need, contact Brooke and the team through the support team, and they can make that happen for you. So looking at both sides of the coin there. So the stock valuation. Working our way through the list. Work in progress. So there isn't necessarily any work in progress reports as such inside EXO if you're doing job costing. But again, if you need to include a work in progress amount in there, whether that's done by a spreadsheet or an external system that you use. So for example, an engineering business which keeps track of its work in progress, and whether that's a mixture of labor and materials or just labor. Putting those costs together and putting that onto the balance sheet. And again, even though it won't necessarily be inside of EXO, providing your accountant with that supporting documentation which backs up the value of the work in progress. Just as a little side note, work in progress is a tax adjustment. So if you're fortunate enough that you can invoice your clients quicker than what your costs come in, well, then you're still going to pay tax on those invoices, even though you make a work in progress adjustment, and vice versa. If your expenses come in quicker than what your invoicing is, you're still going to get a deduction for those invoices despite the work in progress adjustment that you make. But again, our financials at the end of month are not designed to be there for your accountant, they're for operational purposes. So absolutely keep up and do the work in progress accounts. Going back to stock quickly and on the balance sheet here, before I look at GST creditors as well, I'm just going to look quickly at stock clearing. So stock clearing, and also this is relevant for on-cost clearing, which you may have on your balance sheet as well. What your accountant will want to see, and look, it's not necessary to print off an entire year's worth of transactions in there. What I'll do is I'll go to chart of accounts first of all. And we've got stock and on-cost clearing, as you can see, has nil. But if I go to stock clearing, what the accountant may ask, and again, every accountant's different. So some of the things we look at, they may or may not ask for, but we're going to assume worst case scenario, for want of a better phrase, that we're going to provide them everything. They'll want to see, so as you can see here, for the transactions just in June, 180 nilled off with 180 and 12 nilled off with 12. They'll want to make sure that there's no old or obsolete transactions within your stock clearing and also your on-cost clearing, which, to be honest, I haven't seen too many instances with clients where that hasn't been the case. But again, a simple confirmation that, hey, look, these stock clearing or on-cost clearing balances were relating to transactions within the last 5 days of the financial year. And that will often be sufficient for your accountant to sign off on that section of the accounts. If I come back to our creditors, I'm not going to harp too long about this because the principle with your creditors is the exact same with the debtors. The only difference is generally speaking, when you've got an out of balance amount with your creditors, if there is an out of balance amount, it's generally with your creditors as opposed to your debtors. So if I look at the creditors report here, as we discussed before, your accountant will want to see that this balance down the bottom matches back to what is on your balance sheet. So if I go in the reconcile payables report, and we look in here, and again, we can see that there's a relatively minor variance of $682. And we can see where there's a few direct postings and things like that. It's not unusual to have direct postings in this report, because what it'll do is if I click on this, and there's some older type transactions, what you'll find is if you go back far enough, you'll actually see direct postings more often than not to when you first started using EXO, and that's how they bring the transactions in. So it's not necessarily a bad thing that you've got direct postings there. Again, this report is, as it suggests, possible causes for exceptions. It doesn't mean they are the reasons, but they're possible causes. What would get my interest, though, is in here is we can see that there's a number of direct postings which have occurred to the creditors list. Now, as some of you may or may not know, and I don't want to go into too much detail, because again, the purpose of today, but when we do our payments to creditors, we should be using the creating creditor payment facility function within EXO, as opposed to necessarily using too many cash book transactions and not allocating them to the correct creditors, and also definitely not using general ledger journals to post those transactions. So that's a little thing to bear in mind. So if I come back in here, and again, the process is exactly the same. Ideally, we want to make sure that we don't have an out of balance amount. B, if we do, we want that to be a consistent amount, because then it's easier to identify the reasons and again make a decision, as opposed to the variance being like a roller coaster going up and down and moving in all sorts of directions. If we do fall into that third category where it is moving up and down, we need to identify the reasons why it's occurred, and also then identify what we need to do to make sure that they don't happen in the future, so preventing them, and then taking corrective action to clear that out of balance amount and determining what we need to do. More often than not, if we need to clear that balance, one side of the transaction will be your creditors, depending on whether they need to move up or down, and the other side of the transaction will be to your purchasers account. That's where we recommend that they go the proverbial 99.9% of the time. So just keep your eye on that. And again, it's an area where you may need some advice from someone, someone from the Horizon team, for example, to make sure that that's not an ongoing issue. From experience, this is probably where most businesses have their biggest challenges with EXO, especially when foreign currency and things like that come into play. So if I close out of there, we'll move on to other areas. Now, look, one point I want to make is if you've got your stock, your creditors, your bank, and your debtors reconciled, you are the proverbial 90% of the way there. The rest is relatively straightforward, and hence we've spent the majority of our time looking in those areas. What I'm going to do is I'm going to go through the balance sheet and look for how your accountant is going to analyze different areas within these sections. First of all, just while it's here, I'm going to look at suspense quickly. I'm not actually going to go in there. I just left it in there as a trigger for me to talk about it quickly. Now, suspense is something which people sometimes have a fear of using. I'm a huge believer in using suspense, so long as we learn from it. And what I mean by that is, if we're going to do hundreds of transactions over the course of the month. If there's 4, 5, 10 that we're not sure about where they should go, we're better off leaving those transactions to the end of the month and then identifying where they need to go and clearing them up. Because again, it's relative to the size or the volume of the transactions, it's not many. And also, we're going to spend a heck of a lot less time clearing suspense than what we would unwinding errors that we may made by allocating transactions to the wrong accounts. One point that is really important, and I actually didn't make this clear in this morning's session, but suspense, you can actually, I suggested that you want to give it to your accountant with no suspense. That is, I'm partially wrong there. You do want to give it with no suspense, but if you have certain things like sale of assets, it is best to use your suspense and isolate them in those areas, or put them into a proceeds from sale, because what your accountant is going to do is they're going to calculate the depreciation on those transactions and make sure they calculate a true profit or loss on the sale of those assets, using that as an example. But the most important thing is making sure what the accountant gets has got a clear description behind it. So whatever is in suspense, they can clear that as efficiently as possible. What we're going to look at next is we're going to look at your GST. So your GST collected and your GST paid. So I refer to this as what I call your 3-point safety check. So similar to think of when you're driving your car, you got a 3-point turn. Think of it as a 3-point safety check for your GST, and also this is the same for your payroll obligations as well. So first of all, what your accountant is going to require, and I'm going to make a broad assumption that, if not everybody, the vast majority of people listening today are going to be running on an accruals basis of GST and reporting on their BAS. That actually makes things a heck of a lot easier than if you're on a cash basis. Pardon me, if we're on a cash basis, we'll touch on that in a moment. But like I said, I'll make a broad assumption that we're going to focus on accruals for the moment. So what your accountant will want to see is they'll want to see that the GST collected and the GST paid balances as at the 30th of June reconcile to the dollar or very close to what is lodged on your BAS. So again, ignoring the numbers to an extent, but they'll want to see GST paid $24,378 and they'll want to see GST collected $10,778. Ignore the fact that those are fundamentally the wrong way around with your positives and negatives. But anyway, that's what they're going to see. That's what they want to see. So that's their first safety check. They want to ensure that the balance sheet matches what is on the BAS. If that's not the case, that'll lead them to asking further questions. The next bit of proof that they're going to want to see, is under your tax reports. So if we go to tax report by type, as that's now just ignore for that I'm not actually using exact dates, but we'll make some assumptions around this. So when I pull down this report, what I always suggest to people, now, on a quarterly basis for when you lodge your BAS, as you can imagine, it's quite a vast report in terms of the number of pages. So first of all, I don't expect you, nor would I want you to use three boxes of A4 paper to print off your GST reports. You can PDF this to your accountant or simply print the summary page at the end. So what we suggest, and this is the third point in the safety check. So first of all, your balance sheet balance reconciles to what is on your BAS at the 30th of June. And the final safety check, so they're the first 2 points of reference. The third point of reference is that they will want to see that what is in this report for your debtors transactions and your creditor transactions, so the GST totals, they will want to see that these transactions here, or these reports here, reconcile back to what you lodged on the BAS. So if you prepare this report for September quarter, December quarter, March quarter, and June quarter, making sure that they match back to what is on your September BAS, your December BAS, March, and June BAS. So they're your 3 points of checking: your balance sheet, your BASs, and also your GST or your tax report inside EXO. The 3 of them all need to match. Again, if they don't, this will then lead to further questions from your accountant. But this is what they want to see to make sure that it is all reconciled and accurate. So if we close out of there, what we're going to do next is we're going to move on to our payroll. So as you can see here, and we'll come to the profit and loss statement in a few minutes, but what your accountant is going to want to see is the pay-as-you-go withholding and superannuation liability. Now, first of all, the pay-as-you-go withholding liability, they will want this number here at the 30th of June to match to the dollar what you lodge on your BAS as at 30th of June 2014 for your pay-as-you-go withholding. So that's their first check. The other thing to bear in mind is that the vast majority, actually, to be honest, everyone I've dealt with that uses EXO, and I know there's a few exceptions, generally runs their payroll separate to their EXO. So whether they use somebody like an outsourced provider like ADP, or whether they actually use a smaller version of MYOB, for want of a better phrase, or a QuickBooks to run their wage and their payroll process, they still do that outside of EXO. So what your accountant, as their third checkpoint between the ATO and your balance sheet, will be those payroll reports. So with your pay-as-you-go withholding, they will want to make sure that what is on your payroll reports for the year matches what you've lodged with the ATO during your BAS and also your IASs on a monthly basis. Also, what your payment summary statement says. So the statement which we fill out, which summarizes all the pay-as-you-go withholding summaries, they'll want to make sure that they all match. And then, like I said, the June BAS as well. Because what the ATO will do is they'll go, okay, your payment summary statement for the year, let's say, for example, says you paid $100,000 in pay-as-you-go withholding. What you lodged on your BASs and your IASs matches that to $100,000. If those two match, then they're going to be happy. They're going to go, the amount you paid in pay-as-you-go withholding matches what you're reporting to us as well, which is a tick. We want to make sure those numbers balance. The next step is that, and we can't see it here at the moment because we're looking at the balance sheet, but we'll look at this in a moment, is that they'll want to make sure that your P&L in terms of your wages matches what is on your pay-as-you-go summary statement as well, and also what you've included on your monthly pay-as-you-go withholding statement, your IAS or your BAS, depending on what month of the year it is. So again, they're your 3-point safety check. Your wages reconcile across those different reports. Your pay-as-you-go withholding reconciles across those different reports, whether they're self-generated or lodged with the ATO. So that's really, really important. Again, your accountant will get confidence when they see those amounts all reconciling. So you can be rest assured that if you provided that information to your accountant and they didn't match, that'll result to questions and an explanation as to why that's not the case. Superannuation as well, with those reports that you would get from an ADP or from your separate MYOB system, for example, is that they'll see the superannuation liability that you've paid during the year. So as you can see here, as at 30th of June, we actually have a liability for $26,000. Now, I don't know why, but the ATO obviously have their reasons. You could run an accruals version of accounting, but they'll still only allow you a deduction for superannuation on a cash basis. So if cash, so in this example, we would have taken up an expense of $26,000 in superannuation, but the ATO won't allow us to claim that deduction. So if for cash flow purposes, you're in a position where you can actually pay your superannuation prior to 30th of June for your employees, then do it. That'll allow you to claim the deduction in the current financial year. If not, that will be an add back if you pay it at the 28th of July, which is when we'll be due, and as it's due during the course of the month. So that's a really important thing as well if you want to claim that, and also being clear, because the ATO, beg your pardon, the accountant will want to match what your superannuation expense account is for the year, matching that again back to your reports. So as we move on, the next phase, so we've done current assets, we've done current liabilities. The next phase is looking at your fixed assets and also your term liabilities. So your fixed assets, what your accountant reports, general ledger reports, general ledger detail, and this is always a good area to use inside of EXO. Now again, ignoring the dates on these reports, but we're going to run them from, what you'll do when you provide yours to your accountant is you'll run them from July through to June 2014. I'm just doing them on this date just for the purposes of having some data in there. Hopefully it doesn't take too long. But I want to highlight certain things to you within here. So, what's your accountant going to look for? Now, first of all, they're going to ensure that what you're putting in there as a capital item is a genuine capital item. If you've got any amounts in there that could be claimed as expenses, they'll transfer them to the profit and loss, which is ideal because we can claim the tax deduction for them. So that's the first thing that they'll look for. And as I said before, don't worry too much about the numbers. But the first thing they'll look for is to ensure that everything that is included within your fixed asset purchases during the year is a genuine asset. The second thing that they'll look for is a detailed description. So again, we're somewhat limited with what we can include in there, But if needs be, it's always a good idea to include a manual just to write a description on there as well if you couldn't fit all the details within the details part of EXO. So what's the significance of including the details in there? Well, what your accountant is going to require is details so that when he or she prepares your depreciation schedule, they have information in there so that they know what the vehicle is, and there's a clear description for it so that we know when we go to sell that asset in the future, we know which asset we're selling. This is really relevant, especially in capital intensive or equipment intensive type businesses where we might have 10 trucks, 15 bulldozers, etc., where it's really important, or a fleet of motor vehicles. So that's the first thing. The second thing is one that you may not necessarily think of, but put yourself in the shoes of the accountant. So they're designed to be good at what they do with tax and finance, but they might not know what a Hitachi X53 dozer trolley is. So I've taken a bit of creative freedom there with my description, but the point I'm making is when they look at it, they're not going to know what that asset necessarily is. So if you put a clear description in there, what they need to do is they need to find out what asset this is for the purposes of their depreciation schedule so that they can give it a correct effective life. So my belief is if you put a specific detail in there, they'll be able to use a tool like Google Images to identify what it is. So let's say you put that description in there and it comes up with a picture of a bulldozer. They go, oh, it's a bulldozer. And they can then update the depreciation schedule accordingly and give it the correct effective life. So again, a little thing that we might not think of day to day because we're so familiar with the assets that we deal with, but your accountant, for want of a better phrase, may not know from a bar of soap what you've purchased. So that's a little thing to bear in mind, and again, a time-saving exercise as well. So that's what they're going to look for inside your assets. Going back to our balance sheet. So as you can see, we've worked almost our way through. Bank loans. So with bank loans, before we look at equipment finance, so I've got the example in there of a hire purchase liability. But with a bank loan, quite often in businesses, they may be interest-only loans. So the actual balance themselves doesn't move. But what your accountant will want to see is, with the statement as at 30th of June, that they will include a summation of how much interest expense has been incurred during the year. And your accountant will want to ensure that the interest expense per the statement matches back to what is on the P&L. And if you can provide documentation confirming that, not just the balance that the loan is, but also the interest expense, that again makes their life that little bit easier, saves them time and should save you money as a result of that. So again, provide them a statement just like you would a bank statement, which is not a loan, just a normal bank account. Provide them with the details that confirm that in this case the bank loan is worth $150,000. Hire purchase liabilities. Now, a little trick that I'd be willing to share with you, and if this is something you would like, I've already informed Brooke. Let Brooke know, and I'll forward you the relevant documentation. But hire purchase liability. So when you enter into a hire purchase liability with your financier, what they'll provide you is loan documentation with things like the principal of the loan, the interest expense during the course of the loan, your repayments, the number of repayments, and the value of those monthly repayments, more than likely on a monthly basis. And then what your accountant will do is they'll take that information and put that into a hire purchase or an equipment finance schedule, which will calculate the interest on a monthly basis so that it amortizes over the life of the loan. Now, accountants often charge a little bit of money for this, but I've got a spreadsheet where this actually does it for you. All you need to do is plug in the basic details. The reason I share this is twofold. First of all, it's really important that, especially in companies where you've got a lot of equipment being financed, it's really important that you update your interest expense on a monthly basis, because that can have a significant impact on the profitability of your business and therefore on the information that you're looking at and making judgments on the profitability, success or otherwise, of your business. The next thing as well is it means you can take control of that. You can bring that function internally into your business. So for example, you can create a hire purchase schedule, and what it does is you can reconcile those balances. So in this case, 32,000 less 3,500 gives us $28,500 as the balance owing on the loan. So if we were to provide in the schedule $28,500, you'll see that amount come up. So if that's something that you would like and get your hands on rather than pay an exorbitant amount for it, just let me know and we'll be happy to forward that through you and also give you a quick tutorial as to how to set those up if you don't already know. But that's one little thing that has two positives to it. So one, it means your monthly accounts are going to be more accurate, which is obviously a good thing. And second of all, it's going to save your accountant having to worry about reconciling 12 months worth of hire purchases across, potentially a number of different assets which have loans attached to them. The last thing to look at is your inter-entity loans. So for example, if this is ABC Proprietary Limited, and if we're looking at ABC Proprietary Limited and it has an inter-entity loan with 123 Proprietary Limited, we're going to want to make sure that 123 Proprietary Limited has has a $25,000 loan there as well, so that they match. So that is, again, that'll make the accountant very happy. Generally speaking, they'll be doing the whole group anyway, so they'll have the inter-entity transactions or financials as well. But it's really important when we give it to them that those amounts match together. And then the capital and retained earnings. Well, the capital is what you've invested in the business, and retained earnings is the outcome of the lifetime of your business's earnings that are held within the business. So there's not really anything you need to worry about with those two accounts there. So that's your balance sheet. So as you can tell, that is the lion's share of the work. And with the last 5 minutes or so, we're going to look at what the accountant will look at from a profit and loss perspective. So as we go through, go to your profit and loss. Now, what your accountant is going to look for, there's going to be specific things. And look, every accountant is different. They're going to focus on things that are of interest to them, capture their attention. But what we want to do here is we also want to include descriptions around what has occurred during the year, again, to make their life easier. Sorry, just one thing I didn't include, going back to the balance sheet quickly, which I didn't have on here, is it's really important to include your annual and long service leave entitlements, which are owing on your balance sheet in your current liabilities. This is really important because, again, this has been in the news recently about how people are taking less and less leave, which means as a business, we're accruing a bigger and bigger liability, which is going to need to be paid out at some point in the future. Now, there's different strategies around that from an operations perspective, which go beyond the scope of today. But the important thing is to acknowledge that liability. And also remember, if you've employed somebody, let's say for 5 years, and they've got leave owing to them, let's say they've got 20 weeks of leave owing to them, those 20 weeks of leave are valued at their wage today. It's not valued at the time that they accrued the leave. It's as at the cost of their wages today. So it's really important to bear that in mind, and that can be a significant liability for a number of businesses. So moving back to the P&L, pardon me. So your accountant, to be frank, doesn't care about your sales transactions, or they're not interested in getting a listing of all your sales during the course of the year, or I would be highly surprised if they were. They're not going to look into those areas. What I want to provide you a brief overview is of the things that would capture their attention. So again, ignoring the numbers themselves, but actually the nature of the accounts to identify what has occurred. So the first thing, accountants, if you had a stock adjustments account, they would be interested to see what the nature of those adjustments are, because again, they'll want to understand the reasons why, and there could be some potential rules that they'll want to make sure that weren't contravened or anything like that, to make sure that when we did stock adjustments, we did them correctly and accurately. So that's the first thing to do. But generally, when there's stock adjustments, it's more than likely a write-off of stock, whether it's obsolete or spoilage, etc., etc. But they'll want to get an explanation more often than not as to what those stock adjustments are. Moving down a little bit, the computer expenses. They will definitely look at your computer expenses for the reason that they will want to make sure that the expenses included in there are genuine expenses and not capital items. Again, with what we were talking about previously, when we were looking at your fixed assets and making sure there's a clear description. Again, it's the same with your profit and loss items, which your accountant is going to look at. Making sure that there's a clear description in there and that the information, they can make an easy decision as to what it relates to. So computer expenses, they will definitely look in there to make sure that there's no capital items in there. Foreign exchange variance, again, ignoring the actual dollar value itself, but they will look to see, similar to your stock adjustments, they'll look at your foreign exchange variances and go, hey, what are the variances are in here? As just a point on this quickly, I believe that you should always keep your foreign exchange rates in EXO as up to date as possible. It doesn't necessarily mean you need to change them each day, because not many businesses are actually doing foreign exchange transactions each day, but make sure that it's as close to accurate as possible during the course of the year, especially when you do make those transactions. Another thing your accountant will definitely look at is your repairs and maintenance, for the same reason they're going to look at your computer expenses, because they want to make sure that what you include on there, what you include on there is relevant for, so I've just distracted myself by putting that on the screen. Sorry, let's go back. The repairs and maintenance, they'll want to look at that to make sure that what is in there is not of a capital nature. So for example, let's say you've got a printing press, and the printing press, you need to do some basic repairs and maintenance to continue that running. That's fine. If you do something to your printing press which doubles its productivity, you need to capitalize that item, because you've actually enhanced what that item is. So you'll need to capitalize it. So again, provide descriptions around what has been done. As we discussed previously, they'll want to make sure that your wages, this balance here, matches between those 3 points, like we said. So it matches the P&L, matches what we've lodged with the ATO, and it also matches what we've provided in our payroll reports as well. And that's the same with superannuation. Not that we necessarily lodge with the ATO what we've paid in superannuation, but having those checks of making sure what's on the payroll reports matches what's on the P&L, and also what has actually been provided to the superannuation fund as opposed to the ATO. A couple of other ones which aren't actually listed on here on the P&L, but research and development. If you do a lot of R&D, it's really important that they're clearly noted, because they will want to see those expenses in there for research and development. If you have tool replacement, again, they'll want to make sure that there's no capital items in there, but if you're in a business where there's a lot of tools that are being purchased or replaced, then not necessarily need to be capitalized, but again, they'll want to observe that. And also a really big one is travel. They'll want to look at your travel expenses during the course of the year, and making sure that there's nothing in there of a personal or non-business nature. Again, the key is, as I close out of the P&L, is to make sure that when you go to your general ledger transactions, because we're going to provide them general ledger print-offs of these accounts, is that your descriptions are really clear. So if I just pick one of these accounts, and hopefully it doesn't move too slowly, so it shouldn't, there won't be too many transactions in here. Again, we've got a really clear description as to what is in here. So again, for those P&L accounts where your accountant is going to want to look at them, provide them the general ledger detail with it and all the print off and all the data behind backing up what has been purchased during the course of the year. Again, they're going to ask for this information, so we want to be on the front foot to do that. So that's it. So that's how your accountant, that's essentially how your accountant goes about preparing your financials, because they'll want to look at all the information within that to get an accurate assessment as to make sure that your balance sheet reconciles. If your balance sheet reconciles, then your P&L will naturally flow through. And a really important point I want to harp on is that your end of month at June, so your end of financial year close off, should be no different to every other month of the year. The significance of this is twofold. First of all, from a management perspective, your accounts are far more accurate, and you have an accurate reflection of how your business is going at the end of month. I believe you should get your financials no later from your finance team than 3 weeks after end of month. So let's say the 21st, so you can make fully informed and time relevant decisions. There's no point in looking at information 2 months after it happens. So getting that as soon as possible, that's really good from a management perspective. And also from an operational and finance team perspective, is if you're reconciling everything at the end of each month, it means that when there is an error, and because nobody's perfect, we're going to make errors from time to time. When we need to make an adjustment, we can isolate that down to 1 month, because it is far easier to identify a mistake in a 1 month period than what it is over an infinite or 365-day period. So they're my parting thoughts. And also, if you have any questions or want to explore this further with your business, contact Brooke and the team at Horizon, and also they'll be happy to pass on my details as well if that's relevant. But most importantly, these are the steps you need to go through. And if you need to watch this a couple of times, absolutely go through it to make sure that you've actually got your checklist for your business, and work through with your balance sheet, as we've got here, to make sure you've got everything ticked off and that you've got clarification as to what you've included, and your accountant has a clear understanding of what each balance means in your business. So thank you for watching, and if you have any questions, please contact us. Thank you very much.